Hello and welcome to this October 2023 investment outlook from Fidelity. I'm Ed Monk and I'm joined today by the Outlook's author Tom Stevenson to answer your questions about where Tom thinks markets are now and where they may be headed in the months ahead. Now, Tom, as always, we've asked Fidelity investors to submit their questions to you in advance, and I'm pleased to say that a great many have done just that. I'll add here that these are Tom's view of the market. It is not investment advice, but should be seen only as guidance. That said, Tom, let's put some of these questions to you now. And the first one is this. If inflation continues to fall and if interest rates stay higher for longer, is now a good time to buy a bond fund?
Okay.
So, is it?
Well, that's quite an interesting question. There are quite a lot of moving parts there, aren't there? Because if inflation does start to fall, then arguably interest rates will not stay higher for longer.
Yeah.
If inflation does stay high, then I guess the assumption is that interest rates will stay higher for longer. So I guess my base case is that inflation is falling, and that while interest rates will be high for a while and arguably they will come down a bit more slowly than we thought,
Yeah.
I think the direction of travel is that interest rates will peak quite soon and they will start to come down, which then leads to the third part of the question about is now a good time to invest in bonds. I think it probably is quite a good time to invest in bonds because interest rates have pushed to a level now where you can lock in quite an attractive yield, quite an attractive income from your bonds, maybe 5%, about the same as you can get from cash. And if interest rates do start to come down and bond yields follow them down, then I think what we will see is the potential for capital gain as well, because bond yields and bond prices move in opposite directions. As interest rates come down, I think that the price of bonds will actually go up. So you're locking in a good yield, good income, and you've got the potential for capital gain. So I think, yes, it is quite an interesting time to be looking at bonds.
And I guess the motivation for a question like this, and actually we had loads of questions that were sort of related to this theme and specified bonds. The motivation is that people have lost money on bonds, haven't they, over the last couple of years. They're sitting on those losses. They're waiting for that kind of recovery and bounce back in those prices, and they're looking for the thing that's going to be the trigger for that. It's probably worth saying that what we saw immediately before this period was incredibly high bond prices, incredibly low interest rates. Getting back to that is far less certain, isn't it? We might see a reversal partially of what we've seen, but to get back to those levels is maybe won't ever happen.
Yeah, and we're clearly in a transition period at the moment. And I think that, the reason for the question, there's a huge amount of interest in bonds at the moment because for the first time in years, bond yields are now at a level where you can generate a decent income from them. So they are finally a viable, a plausible alternative to equities. But we've been waiting for this turn for quite some time. If you could roll back to the beginning of this year, I think that we and many people expected that interest rates would peak quite soon. We thought that by the middle of this year, we'd see the peak in interest rates and rates would start to come down again in the second half of this year. That now looks like it's been pushed forward probably by a year. Yeah. And I think that actually we won't see a fall in interest rates until, maybe the middle of next year. And then I think the key thing is that the expectation now is that they're not going to come down quickly, that they're going to drift down. So that's where the higher for longer narrative comes in.
And just finally on this question before we move on, those expectations around interest rates and where they are, where they will peak, how long they will stay at a peak and when they'll come down, they're really sensitive, aren't they, to any news, because any new figures on jobs or on wages or on inflation in general seems to be moving those expectations quite a lot. The market is very sensitive.
Yeah, it's very twitchy at the moment, and it's because we're close to that watershed point.
Yeah.
I think most people assume that if we're not at the peak in interest rates, then we're certainly close to it. And so because we're close to that turning point, I think everyone is focused on every nuance of what central bankers have to say, all the data that comes out, the inflation data, the growth data. Everyone's watching it very closely.
Okay, well, let's move on for now, Tom, because we're going to return to some of these themes in other questions, I'm sure. And the next question is this. I hold investment trusts focused on renewable energy and infrastructure with capital values that have reduced by 15 to 30%. With interest rates likely to remain high, is the best thing to do to hold these trusts, or may the risks be too great?
Okay, so I think the thing. Okay, so we're talking about investing in investments which offer a high-ish and a sustainable yield. That's why people invest in infrastructure, particularly. It's also true of commercial property, for example. And I think that's related to this answer. So I think as interest rates have risen, then the yield which those infrastructure funds or the property funds need to give investors have also pushed up to make them competitive. And that, same reason that we talked about before, prices and yields move in opposite directions. So what we've seen is quite a big correction in the value of many of these investments. Now, I think it's really tempting when you've suffered losses on an investment to worry about it and to think that that's going to go further, and to effectively to crystallize that loss by moving out of it. I look at it differently. I think if you look at the long-term attractions of infrastructure, and in particular renewables, which the question mentions, those haven't gone away. Those are still very attractive. And if you're able to lock in a high yield, a high income from those, I think, again, that starts to look quite attractive. And I think the same is true of commercial property. I think that we've had a really very significant correction, particularly in this country, in the value of commercial property, down sort of 15 to 25% in many cases, the values. And, you're now getting a high and attractive yield. And I think that process has probably worked its way through now.
Yeah, it's interesting. These particular assets. So these are investment trusts. That means they're technically equities. They're shares. They're traded on the stock market. But as you say, they behave in many ways like a bond. But then, of course, underneath all of that, you've got the fundamental asset, which is neither of those things. It's a physical asset in the real world doing something. What do you focus on when you're investing in those things? Because each of those elements and ways of looking at an asset like this is going to affect its performance.
So I kind of didn't answer that part of the question, actually, which is the fact that they are investment trusts. So there's an element here which is related to the underlying asset and the impact that rising interest rates have had on those underlying assets. But there's also the investment trust element, because an investment trust, as I think you were hinting at there, the price of an investment trust is only sort of loosely related to the value of the underlying asset. The investment trust share price can be at a premium or a discount to those underlying assets. And because those assets prices have been falling, the discount of the share price to those assets has widened. So, and that's accentuated, it's magnified the problem with investing in these assets through an investment trust. But of course, it works in the opposite direction as well. And that when, as those asset values stabilize and maybe start to go up, then I think that the discount will narrow on the investment trust. So it's another reason, actually, just to be cautious about being too negative. I'm recommending that people, don't get overcautious.
Yeah, indeed, and no rash decisions with things like this, because a lot of the questions today are to do with assets that have lost value. And as you say, and I'm sure you'll say again, the sort of moment of maximum danger is right when those losses hit and you're tempted to make some big change in your approach and lock in those losses.
Yeah, and very often precisely the moment not to do that.
Indeed. Okay, well, let's move on for now, Tom. And the next question is a bit technical, but a worthwhile question, I believe. The yield curve has been inverted for 15 months. This is supposed to be the best predictor of an impending recession. So where is this recession? So let's
quick explanation.
Yes.
Then. Okay, quick explanation of what the yield curve means. So the yield curve is basically the measures the relationship between the yield on short-dated bonds, so bonds which are maturing in maybe 2 years' time, compared with the yield on longer-dated bonds, so bonds which are maturing in 10 years or 30 years or whatever. So traditionally, you would expect the yield on a longer-dated bond to be higher because there's more risk. If you're lending for a long period of time, you want to be rewarded for the risk of inflation, of all sorts of uncertainty,
failures, credit failures,
all those things. Now, with an inverted yield curve, the reverse happens. So the short-dated bonds are yielding more than the longer dated bonds. And that traditionally has been an indication of trouble ahead, because what it's saying is that, you know, interest rates are being tightened to such a degree in the short term that it's likely to cause a slowdown in the longer term, which of course is what monetary policy is designed to do. That's why interest rates are pushed up, to slow the economy. And the expectation then is that inflation will be lower in the future, and so bond yields are lower. So that's why you get this. That's the message from the inverted yield curve. Actually, what we're seeing at the moment is that inversion is flattening out, and in fact is moving. We're moving to a position where longer dated bonds are actually yielding more than shorter dated ones, which is the normal state of affairs. And why is that the case? It's because people expect inflation to be stickier, to hang around for longer. And therefore investors are saying, I want a bit of compensation for that. So that's the explanation. What was the question?
So the question was, so where is the recession?
Yes.
We've had 15 months of the bond market. And just to break it down even more, by the way, what we're talking about is a chart, isn't it? If you plot yield against the duration of bonds, this is the curve that we're talking about. Yeah. The fact it's been inverted should, or has often in the past, predicted recession. That has not yet come about. Why is that?
Well, I mean, whether or not we go into recession, I would say, is the biggest question for investors at the moment, because it will drive everything. It will drive the movements in interest rates and inflation. You know, it has been delayed longer than people expected. I think people expected that when you've got this really aggressive tightening in interest rates, which is what we've seen over the last 18 months, then that is almost inevitably going to lead to recession. And the question's right, it hasn't happened. The economy seems to be really resilient. But there are a lot of people, many of our colleagues among them, who think that actually the recession, the impact of higher interest rates has just been deferred. Yeah. And that it is coming down the track. And I think this feeds into the argument about, you know, why it's a good time to invest in bonds. Because if we do head into a slower economy and interest rates start to come down, bonds look interesting.
And it speaks to that question that we've sort of spoken about a few times on these videos, on the podcasts, and in various places around the efficacy of interest rate rises and why they might be less effective these days than they were in the past. Yeah. All sorts of possible reasons, also reasons that change from region to region. But say here in the UK, we know this relates to the mortgage market. How many people have mortgages? Well, as a proportion, it's fewer than they used to be. Yep. So interest rate rises are going to have a dampened effect. There's also something going on, we assume, with the pandemic and savings which have been built up during those years because spending was so much lower. That has to work its way through the system as well. And as you say, this might just be adding up to a delay, really, in the effect of higher interest rates on growth.
Yeah, I think you're absolutely right, especially about that point about savings, that, you know, clearly people did build up some savings during the pandemic. And they've been, and having those savings, having those sort of stronger household balance sheets has enabled people to ride out the rise in interest rates a bit more than maybe they would have done in previous cycles. So I think it's quite a good argument to say that actually the problem has just been pushed a bit further back. It hasn't been cancelled. You know, yeah. I think it's very likely that we will get a slowdown in the economy, maybe a recession.
And just finally, before we move on, but is there not a case that some investors might want to see not a huge recession, because that can be really, really painful in all sorts of ways, economically and socially, but growth slowing down and maybe negative growth for a period, because that is what we need to see before interest rates will peak and then eventually come down?
Yeah, absolutely. I mean, what investors really want is for interest rates to come down, and the price that you have to pay for that is a slowing economy. That's that. So you're right. I think in some ways, what you want is the Goldilocks scenario. You want
a soft landing.
You want a soft landing. You want the economy to slow just enough. You want interest rates to rise just enough to slow the economy without causing a recession.
Okay, well, let's move on now, Tom. A more practical question this time. How do I turn my investment funds into regular income in around 10 years from now?
Well, first of all, well done to the questioner for actually, you know, thinking 10 years ahead and planning.
Yeah, that's probably the first thing they've got right, isn't it?
Yeah, absolutely right. And you clearly, as you approach retirement and you've built up your pot of money, you know, you've been focused on growth throughout your working life, and you will want to turn that into an income. So you'll probably want to think about asset allocation. You'll be thinking about, where am I actually investing this money? Because maybe some types of assets, we talked about infrastructure and property before, that they're income focused assets. They're focused on generating an income. Equity income funds, maybe. So you might think about where the money is invested. You might also start to think about the types of funds in which they're invested. So we've talked in the past about different share classes: accumulation share classes, income share classes. The income share class, as its name suggests, designed to facilitate the payment of an income. But I guess the one word of caution I would point to is that someone coming up to retirement is probably hopefully looking at quite a long retirement. So it's not like a cut-off point where you stop accumulating and you go into income generation. If you're going to be living hopefully through a nice long retirement, then you're going to need to maintain some growth in order to combat the impact of inflation over that period.
Yeah, it's interesting because some people would look at this question and say, well, why would you not just be in the highest growth assets you can and then just sell them down as and when you need that income? Because overall, that's maybe the best way to do this.
And some people do adopt that approach.
And they do indeed. But the reality is, I guess, for many people, if not most people, that's going to be simply too volatile. You're going to need assets with a specific income generation kind of mandate in order to give you the income you need. And the other part of this is how you arrange these investments within your wider financial mix. Lots of people who are using investments for income will take that income in the first instance from a pot of cash and then use investments to replenish that pot of cash, because in that way they can be more sure that they're going to get the income they need. We've spoken about it loads of times in the past in relation to retirement income. Arranging your finances in that way, and with 10 years to go, you can do that gradually.
Yes, and you're absolutely right to highlight the importance of cash, because the one thing that you don't want to be in this situation is a forced seller of assets. We've talked about the importance of having a cash cushion to enable you to take your regular income out of that cash cushion to allow your investments to continue and to navigate the inevitable volatility of markets.
Yeah, and also just to get your expectations sort of lined up in terms of what your income needs to be, but also how certain or uncertain it needs to be. Because if this is going to relate to retirement, you might be looking at products like annuities, which are guaranteed income, or partial annuities, which give you some guaranteed income, but the rest you're willing to let fluctuate with investment performance. So you need to have an understanding of what your expectations, your needs, and your tolerance is of uncertainty of that income.
Yes, and indeed the timing of those needs, because it may well be that in the early years of your retirement you're happy to ride the ups and downs of the markets, but then maybe in your 70s, when your appetite for tolerating that up and down maybe diminishes, you may want to start moving stuff over into an annuity at that stage. And of course, the advantage of delaying the purchase of an annuity is the longer you leave it and the older you are when you buy the annuity, the better the annual return that you'll get.
And we're bound to say here that financial advice can really, really help. 10 years before retirement or when you need an income is a great time to get it.
Yeah, absolutely. Well, it's always better to get advice when you don't actually need it. And so to do it in advance of, you're more likely to make sensible decisions if you're thinking about something 10 years hence. Great.
Well, let's move on for now, Tom. The next question is this. What's your opinion about Scottish mortgage? I have 20% of my portfolio there, and it hurts to see a 45% drop in its price. A popular investment.
Yeah, so just for people that aren't familiar with Scottish mortgage, we should just explain that this is an investment trust which has quite an aggressive investment style. It's looking for long-term winners. It's looking to identify a handful of really strong winners. And indeed, in the past, it's been successful in doing that. It has a real focus on technology, stocks, in particular in the US. So as interest rates have risen, the environment has moved away from that kind of stock in some cases, and so the fund has not performed as well. So it actually comes back to a previous answer that I made about the temptation to when you've suffered a loss, to just kind of get away from it and to sort of put it behind you. And so it's really important not to look at what's happened in the past, because that's done. The point is to look at your investment now and to make an assessment of what's the outlook for it now. So, one of the key things driving the performance of those growth stocks, which Scottish Mortgage focuses on, the technology stocks in particular, is interest rates. And if you feel that interest rates are at a level where they're likely to come down from now, maybe the environment for those kinds of stocks will improve. And if that were to happen, because this is an investment trust that trades at a discount to its underlying assets at the moment, that discount will probably narrow. So, this may not be the time to jump ship.
Yeah, and as you say, Scottish Mortgage did really, really well, didn't it? And lots of people did well out of it because it was accentuating the upside of those. I mean, these are the biggest companies in the world. You used to call them the FANGs, we call them the Magnificent Seven nowadays. These American huge tech companies that are a lot of their valuation is based on what they can do in the future, their earnings in the future. But because people were looking so far into the future for their earnings, it all became very sensitive to interest rates rises and to inflation. And they became worth less in real terms because inflation rose and interest rates rose. That hurt the price of those companies, and something like Scottish Mortgage was hurt a lot in the process.
Another factor to bear in mind with those stocks, of course, is that if we move into a more difficult economic environment, there's a reason why those stocks are so highly valued. It's because they are quite defensive stocks, and they are able to generate earnings growth through the cycle. If we move into more difficult times, they may well actually perform pretty well.
Yeah, and just finally on this, those companies, as we've said, they are also the biggest companies in the biggest stock market in the world. So if you own some Scottish Mortgage, and this questioner says they have 20% in it, what is the rest of their money invested in? Because if it is just in a generalist global fund, they're likely to have a lot of these companies anyway on top. So make sure you're diversified when you have something that specializes in one particular type of company.
Yeah, and diversification is an important point to raise here because of the fact that this particular investor has a relatively high proportion of their assets tied up in one trust, one fund, and I think it's hard to overstate the importance of diversification, because of course, in years when Scottish Mortgage was doing well, this investor would have felt extremely pleased to have such a high exposure to it. But we don't know what the future holds, and 20% is a lot to be in one fund.
Okay, do you think a recession is coming? And if you do you think gold will shine as people will become more defensive, or would you stick with stocks and ride it out? So gold and the threat of recession.
I mean, we've talked about recession. So we won't labour that point. But I mean, how would gold respond in that situation? Well, I mean, there are a few factors that are important to the gold price. One is interest rates, because one of the key things to bear in mind about gold is that it doesn't pay an income. So therefore, as interest rates rise and as the income that you can generate from other assets improves, whether that's bonds or cash, then gold becomes less attractive because there's an opportunity cost in holding gold. So I think the direction of interest rates is important, and if there is a recession, then interest rates will presumably come down. That could be good for gold. The other factor that's important with gold is it tends to be viewed as a safe haven in tricky times, and we certainly face tricky times. Recession is one aspect of that. We've got the situation in the Middle East at the moment as we speak, flaring up, and I think gold has actually, bounced back a little bit in response to that. I guess the third point to say about gold is that it should only ever be a relatively small part
Yeah.
of a portfolio. It is volatile. It is driven by all of these external factors. It does play a role in a diversified portfolio because it behaves differently to other assets like shares and bonds. So I think there's an argument for holding some gold, but never a huge amount relatively.
Yeah, and a mistake that sometimes can be made is for people to try to capitalise on the periods when gold appreciates by a lot in a short period of time, which, I mean, that does happen from time to time in periods of extreme stress. And we may be about to see one of those now, as you say. But the problem with doing that is that if you're banking on that happening, then the other assets like shares, like bonds, what have you, are likely to suffer big losses. It's a very unbalanced way of running a portfolio, really. And gold, as you say, should have a function, but it shouldn't be the thing that you're hoping to drive your returns, because if that's happening, then something very bad is happening elsewhere.
And also, if you're thinking that gold is going to drive your returns, then you're probably confident in your ability to time those movements. And as we know, timing any market is not easy, but timing movements in the gold price, I think, is as difficult as any other asset.
Okay, well, let's move on for now, Tom. The next question is this. I hear much talk of asset allocation, e.g. 60% of shares and 40% in bonds for a long-term medium risk investor. But is there merit in ignoring all of that and investing 100% of my investment portfolio in shares and the rest in cash? So instead of 60-40, 75% in shares and 25% in cash. So forgetting bonds altogether and taking advantage of the higher rates of cash.
Well, I would say probably not, because I think that bonds do have a role to play in a diversified portfolio, because like gold, they behave differently in different circumstances, and very often, not always. I mean, last year was a good example when shares and bonds moved together downwards. But usually bonds and equities move in different directions. So it can give you a smoother ride. I think another aspect to think about here is your age. So I mean, if you were in your 20s and you're just starting out on your investment journey, then actually what you're really focused on is long-term growth. Because you're just starting out, you can actually afford to ride the ups and downs of the market, because there's plenty of time to make up for downturns. You're probably not that fussed about having a big exposure to bonds. If you're in your 50s and you're looking, it's very important for you then to have a smoother ride and to have a bit more certainty about your capital, then I'd say you probably want more bonds. So I think the answer, as ever, is it depends.
Well, it depends. I mean, I'm reminded of something you said earlier on, which is that if interest rates rise, that's good for cash, obviously, but if it leads to so if interest rates eventually start to fall, bonds will then recover.
Yeah,
and it would be a bad moment to ditch bonds before that has a chance to play out. And the questioner may be right in saying that some of the old wisdom around asset allocation has or needs to change, because cash is now attractive in a way that it hasn't been for a long time. But it would be wrong to say that bonds is now sort of unsuitable or can't offer something.
And I think cash is very attractive at the moment, and we're seeing that in the fund flows. Lots of money is going into money market funds, cash funds, and actually it's being pulled out of bond funds. I think that might be a mistake, because in that circumstance that you talked about there of falling interest rates, well, the returns on cash are going to fall immediately. At the same time, though, the fall in interest rates is going to help bonds, because bond yields will fall and yields and price move in opposite directions. So actually, I can see the attraction of cash at the moment, but I think that bonds, for me, are a more attractive asset class at the moment than cash.
Okay. Well, let's move on for now, Tom. It says, referring to your comment, Tom, I don't know if you remember making this comment, but it says, referring to your comment that the markets have had a somewhat unremarkable year, rising and falling, but not giving too much cause for concern.
Right. I don't remember saying that.
The question begs to differ with you, Tom. The markets may have been somewhat benign, they say, but investment trusts again, investment trusts have had a horrendous time. My portfolio of trusts is well diversified across sectors and countries, but is showing in excess of a 10% drop over the past 12 months. What is going on?
Right. Okay. Well, I don't remember saying that. I guess probably what I was driving at, if I did say that, was that the markets have gone up and down, but
they're positive this year. Right?
They are positive this year, and over a 2-year period, they went down and they've gone up again. They've kind of broadly moved sideways. I think one point that I would make, though, about the market, looking at the market performance, is that the market performance is so skewed by the performance of a relatively small handful of companies. You talked about the Magnificent Seven. If you scratch beneath the surface, you'll see that actually an equal weighted index, or indeed indices of smaller companies, have actually done a lot less well than the headline level of the market. So I suspect that this questioner's experience through their investment trust is actually not dissimilar to the performance of the broader market, if you exclude the performance of these, small number of stocks which have dragged the market higher.
Yeah, and investment. Well, this is the third question I think we've had that's spoken about investment trusts. They are popular with small investors, and so these losses that they've experienced have been really, really painful. When you look into it, there tends to be a specific story for each one. Each one's got but perhaps the gearing was high on a particular trust. As interest rates have risen, that's made the borrowing more expensive. There's been a problem in some investment trusts of valuations of unquoted shares. That's hurt some trusts. And of course, they are stock market instruments, and there has been a general move out of stock markets into cash, as we've said. There could be various reasons, or a combination of reasons, why investment trusts have done worse, right? It might not be one particular story.
Yeah, and they do tend to magnify the underlying movements in the markets. And I think you're right to say that investment trusts are popular, and there are good reasons why they're popular, because they're quite flexible investment vehicles. They allow you to invest in things, maybe more illiquid investments, whether that's property or smaller companies, or overseas markets, emerging markets, which are maybe better suited to that closed-ended vehicle that an investment trust is. But they are a little bit more complex. They do have these elements of gearing, for example. They're allowed to borrow money. They do trade at a discount or a premium to the underlying value of their assets. So they are more complex. I mean, I happen to think they're a very good investment vehicle. I think they're attractive. But I think people should go into them with their eyes open, realizing that there are added levels of complexity.
Indeed. Well, this we'll move on now, Tom, to the last question for today. And it is this: why should I invest in the UK? Whilst a high proportion of companies in the FTSE are global, it feels as if it's undervalued and in the doldrums. I appreciate that the US is at the top end of its valuations, but it still feels as if it would be better investing in the US, as they have the momentum to drive valuations forward, and ultimately it will benefit me more than investing in the UK. Am I wrong? The questioner asks.
Well, I mean, the questioner is right on lots of aspects here. I mean, the UK is clearly much less highly valued than the US market. And in fact, that's particularly the case, I think, with the more domestic focused indices within the UK. So the FTSE 250, for example, it trades on about the same multiple of earnings as the FTSE 100. It's only about 10 times earnings, 10 or 11 times earnings. But the FTSE 250 actually has much better growth potential, according to the forecast, than the FTSE 100. So arguably, that's where the real value lies in the UK market. I think that they're right about the US, that in some ways the US is an attractive market in the long run. I think it does have great growth potential. But in terms of valuation, on about 20 times earnings, it's almost twice as highly valued as the UK market. I think there's much less scope for the US market to appreciate in valuation terms. So there's a lot of pressure on earnings to come through to drive the US market. In the UK, expectations are so low that actually, as long as things don't go badly wrong, I think there's the potential for a decent return.
Yeah, and it sort of raises the question about how much should you allocate in sort of, under normal circumstances to each of these markets. I mean, the UK is what, 4 or 5% of global markets
Value.
by value, versus 40 to 50, I don't know, something like that for the US. So you're bound to have more in the US. Really, you should be talking about slight changes of emphasis, really, rather than wholesale, sort of betting on one market versus the other, because you're going to get those bets wrong.
Yeah, you're right. Unless you're making a really bold call on the direction of different markets, you are going to have much more exposure to the US market than the UK market.
Okay, great. Well, that's all the time we have now for questions. Thanks to Tom for joining us today to answer them. If you've asked us a question that we didn't get round to answering, we have a special edition of the Personal Investor Podcast, which will answer yet more of those questions. You can listen to that on iTunes or wherever you usually get your podcasts. A full copy of Tom's investment outlook is also available to download at fidelity.co.uk/outlook. Thank you so much for watching, and do join us again next time. Bye for now.